Right, so we are continuing with question 3 on the financial reporting. And question 3 is basically on standards. And the number of standards are in place here. So let's see the requirements. Okay, everything has its requirements. So A, we are told that Carson constructs retail vehicle outlets and enters into contract with customers to construct buildings on their land. Now be careful here. The company constructs retail vehicles outlets and they enter into contract with what? Customers to build on their land. The contract has standard terms which include penalties payable by Carson if the contract is delayed, or payable by the contract if the contract cannot gain, if Carson cannot gain access to the what? Construction site. So two things. If the company, that is Carson, delays, what do? They pay a penalty. Then if the customer also does not make the land easily accessible, they will also what? Pay a penalty. Very important. Due to poor weather, one of the projects was delayed. As a result, Carson faced additional costs and contractual penalties. Yes? As Carson could not gain access to the construction site, the directors decided to make a counter claim against the customer for the penalties and additional costs which Carson faced. Did you get a technique? So the company delayed one of the projects because of weather. So they are required to pay what? Penalties. However, the customer also did not make the land easily accessible. So right now the directors of the company is playing smart. So we know we will owe you. You too, you owe us. So they are now making what? A counter claim from the customer on that same contract. Carson felt that because claims had been made against the customer, the additional costs and penalties should not be included in contract cost but shown as a contingent liability. Carson has assessed the legal basis of the claim and feel it has enforceable rights. So again, Carson has made a counterclaim, and because they have made a counterclaim against the customer, the additional costs they will incur for delaying and the penalties they will receive, they believe that they are going to what? Win the case because they have enforceable rights. So they didn't add it to the contract cost, but they have treated this as what? Contingent liability. Now what is a contingent liability? What is a contingent liability? IAS 37. It's not a present obligation. When you start with a present obligation, then you are defining liability. What is contingent liability? No, it's important. Let it be there. Talk. Talk. Yes. Contingent liability is a possible obligation, okay, possible future obligation as a result of what? Past events. The amount, okay, and the time of settlement of which depends on the occurrence or non-occurrence of a future event, which is not within the control of what? The entity. So, we are likely to pay something, but the time and the amount we don't know. However, we will not pay, or we will only pay when something occurs or something doesn't what? Okay. So a typical thing is the legal case. So if you take a matter to court and you know you are going to be paying something, it's a contingent what? Issue. So that one depends. If it is, you know, I gave you the 4 thematic things that you do to clarify. I don't know if you remember. If it is certain that you will pay, you have to disclose it. Sorry, you have to recognize it and then disclose it. Then if it is probable, then you recognize it as a liability asset, you disclose it in the note. Then if it is in the middle, something like that, you disclose it in the note as a current contingent liability. It's a contingent asset, you ignore. But if the case is, as I always say, foolish case, you ignore it in both cases. I'll be getting the idea. So that's contingent liability. So whatever penalty payable, because the company did a counterclaim, they believe that they are supposed to treat that as a what? A contingent liability. In the year ended 28 February 2017, Council incurred general and administration costs of $10 million and costs relating to wasted materials of $5 million. Additionally, during the year, Council agreed to construct a storage facility on the same customer's land for $7 million at a cost of $5 million. The parties agreed to modify the contract to include the construction of the storage facility, which was completed during the current financial year. All of the additional costs relating to the above were capitalized as assets in the financial statements. The directors of Carson wish to know how to account for the penalties, counterclaim, and additional costs in accordance with IFRS 15, revenue from contract with customers. Required. Advise Carson on how the above transactions should be dealt with in each financial statement with references to relevant international financial reporting standards. So a lot is in this question. But our focus is on the last paragraph because the examiner says the directors of Carson wish to know how to account for EBASE, the penalties payable, and how to account for the counterclaim they have made, and also how to deal with what? The additional cost. According to IFRS 15. Now with IFRS 15, if you remember that carefully, we said this is an accounting standard that is replacing two accounting standards basically, but there are other things. Construction contract IAS 11 and the revenue IAS 18. Now under IFRS 15, we mentioned that we use the 5-step module or framework. So the first thing is that we need to identify a contract with what? Customers. Certainly from this question, you can see that we have incurred, or we have a contract with a customer whose land we are building on. Then the second thing is what? Identify the performance obligation. What is the performance obligation in this case? It is the building that they are, yes, the building they will be constructing on the land. Then 3, we determine what? The transaction price. Now, if you check in this question, from the beginning, the first, second, from the third paragraph is where we see some information. That Carson incurred general administration, okay, not that. Additionally, during the year, Carson agreed to construct a storage facility on the same customer's land for $7 million. So that is the additional thing also that the examiner is talking about. At a cost of $7 million, but they are going to charge them how much? Hey, at a cost of $5 million, but they will charge them $7 million. So if you check, it means the transaction price is how much? No, the transaction price is going to be $7 million. Are you getting it? Because what did we say was the transaction price? What's the definition for transaction price?
The amount that the customer pays.
The amount the customer pays to the supplier. So the performance the transaction price is the amount of consideration that the entity receives in return for the transfer of goods and services to the what? Customer. So when we build, this is the additional cost, $5 million. When we build, this is how much we are charging them, $7 million. That's the transaction price. Then we are told that the parties agreed to modify the contract to include the construction of the storage facility, which was completed during the current year. All of the additional costs relating to the above were capitalized as assets in the financial statements. How? How? So this is the additional cost they incur. In additionally, blah blah blah. Remember, we are told that this thing was completed during what? The current year. So if it was completed during the current year, there is also another item here. In the year, Carson incurred general and administrative expensive cost of $10 million and costs relating to wasted material of $5 million. They are saying that all these costs relating to the above were what? Capitalized as assets in the financial statement. Why should they capitalize it? That is why they are seeking your advice as their accountant. So what do you think has to be done?
But you can't capitalize administrative costs.
Okay.
And then wasted materials. On which basis is this time to capitalize?
That is why the examiner is asking you, give them the advice based on relevant accounting standards.
So supposed to treat them as expenses. Because they don't meet the criteria for capitalizing them as assets.
Okay. Okay. So general and administrative costs naturally has to be treated as what? Expenses in the income statement. And then wastage of material. If you waste the material, why do you capitalize that? That has to be written off. Alright? The company doesn't have a professional accountant. That is why the examiner is putting you there to advise them.
I don't like the company.
Alright, so then they modify the contract to include the 7 million as the transaction price and what? The 2 million. So what does it mean? It means for the current year ending, since the job has been done, it means the performance obligation has been what? Satisfied. Isn't it? So for the current year ending, revenue, they will recognize what? This 7 million. Agree? Agree? Because we said that we recognize revenue when the performance obligation is what? Met or is met. Hence, since we charge them 7 million, we're going to be recognizing that. But and then at a cost, this is the cost we are going to be incurring. So cost on that is going to be what? 5 million on that. Now we know that because still during the year they incurred some cost. But let's go back to the question to see what is happening. The examiner said, or the directors wish to know how to account for the penalties, the counterclaims, and the additional cost. So we are saying that the additional cost, how should they account for it? The first thing, penalties. How should they account for the penalties? Since it is something they are likely to pay, but has not been settled, or they have not paid it yet, that should be recognized as what? A current liability. But you know the amount is not told here. We are not told the amount here. So, and the issue is still in court. Are you getting it? Because counsel has assessed the legal basis of the claim and feel it has enforceable rights. So, we are told that the penalties are not included in the what? Contract cost, but are shown as what? Contingent liabilities. Do you agree that they should be shown as a contingent liability? Yes, because the issue is in court. Then what about the counterclaim that they are also making? It's a counterclaim, and the issue is still in court. We don't know the amount, so still that should be shown also in what? As part of the liabilities of the company. Then the additional cost they incurred. That is what we said, the wasting cost. So the additional cost, third item, the additional cost they incurred. General and admin. That 10 million, and then what? Wasted material. How much? 5 million. So this 15 million is supposed to be what? Treated as expenses. Does it make sense? Supposed to be treated as expenses. So these are the three things that were highlighted that we need to talk about. How the penalties to be treated, the counterclaim, and then the additional cost. So this has to be taken to the income statement as part of what? The expenses of the company. So that is it about that. So they recognize this revenue, and then these costs should be part of the cost that will come in the income statement. Now here you are not preparing income statement, you are just talking. So you are not going to be really doing any calculation stuff here. You're just going to be talking. Are you getting it? You're just going to be talking. That's why I put the thematic areas like this, then I'm telling you what you are supposed to do. So this is what goes to the income statement, the additional cost. They have capitalized it or treated this as a contingent, but it has to be what? Written off. Then the revenue to the additional contract must come in the income statement. Then the cost to the contract must come. And so that is how we deal with this one. So as I mentioned, May 2019, we expect the examiner to set some question on IFRS 15. And as a standing examination, we don't expect him to do anything humongous, but he can bring the theory question. That is why it's very important for you to understand the 5 framework. Are you getting it? And know the meaning of everything there. Okay, very important.
No condition.
Okay, so let's go to B. Now B is actually on financial, it's like financial instruments and then liabilities, okay? So it's like IFRS 9, financial instruments, and then also IAS 37, but usually it's financial instruments in this one, so IFRS 9. The directors of AFCO, a public limited company, are reviewing the financial statements of 2 entities which are acquisition targets, Kevor and Leiden. They have asked for clarification on the treatment of the following financial instruments. Okay, boom, within the 2 entities. So B is on IFRS 9, financial instruments. Very important. So let's go. Kevor first. So let's treat Kevor or Kavor, depending on the school you attended and the teacher who taught you phonics. Kevor has 2 classes of shares, A and B. Now I want you to follow this carefully. A shares are Kevor's ordinary shares and are correctly classified as equity. So there is no problem with the A shares. B shares are not mandatorily redeemable shares, but contain a call option allowing Kevor to repurchase them. Listen carefully. So the B shares are not mandatorily redeemable. Now, if shares are mandatorily redeemable, that means it becomes what? A liability. Because a liability, we recognize a financial instrument as a liability when there is an obligation to what? Pay or repay it. So if it is a mandatorily redeemable, then the B shares will not be classified as equity, but will be classified as what? A liability. But in this case, they are not mandatorily redeemable, meaning they don't have an obligation to redeem the shares. However, they have a right, that is what? An option to redeem the shares. Let's go. Dividends are payable on the B shares if and only if dividends have been paid on the A ordinary shares. So, in other words, here also, the A shares are our ordinary shares, Kevor's ordinary shares. We will only pay dividend on the B shares if and only if we pay dividend to the owners of the company. Let's go. The terms of the B shares are such that dividends are payable at a rate equal to that of the ordinary shares. Additionally, Kevor has also issued share options which give the counterparty right to buy a fixed number of its B shares for a fixed amount of $10 million. Who is the counterparty? The counterparty are the holders of the B shares. Okay? The shareholders of the B shares. Now, the contract, listen carefully. Additionally, Cable has issued share option. Listen to the word. It is a share option, meaning you can also decide or not. So you have a right to buy and not the obligation. To buy a fixed amount number of the B shares for how much? $10 million. The contract can be settled only by the issuance of shares for cash by Cable. The contract can be settled only by the issuance of shares for cash by Cable. The examiner said, discuss whether the above arrangement regarding B shares of Cable and Leader should be treated as a liability or equity in the financial statement of the respective issuing entity. So the B shares, based on the understanding you have here, should Cable classify it as an equity or as a liability? Based on the understanding of how a liability should be recognized and how an equity should be recognized. What do you think?
The second sentence is confusing.
Which one?
The B shares are not mandatorily redeemable.
That's what I
Since they are not
explained.
mandatorily redeemable, then it can be a liability for them to pay.
So they are not paying.
So they are not going to pay.
Yes. Then the last statement of the question also is important. It says the contracts can be settled only by the issuance of shares for cash by Cable. So we are not going to give them any money. We will settle the contract only by giving them what? Shares. Meaning, at the end of the day, pay 10 million shares, no, better. So if we don't have any obligation to redeem the shares, to give them money, and our obligation is to give them shares, then the shares should be classified as what? Equity. Does it make sense? So primarily, how you classify something as equity or as debt is, do we have an obligation to repay? In this question, as you can see, we are not mandatorily required to pay. And as you can see, this contract can only be settled in cash. Because of that, it has to be or not equity. So the B share should be classified as equity and not a liability. Why? Because it can only be settled in shares or the company doesn't have any obligation to repay. Kofi, very idea. If and only if now, okay, no. How goes school? Oh, yeah, you go early, cry. So let's go to the second one. Leiden has an issue two classes of shares, A shares and B shares. A shares are currently classified as equity. 2 million B shares of nominal value of $1 each are in issue. The B shares are redeemable in 2 years' time at the option of Leiden. Leiden has a choice as to the method of redemption of the B shares. It may either redeem the B shares for cash at their nominal value, or it may issue 1 million A shares in settlement. A share are currently valued at $10 per share, or A shares, are currently valued at $10 per share. The lowest price for Leiden's A share since its formation has been $5 per share. So in the book of Leiden, B shares should be classified as what? Equity, liability, or a compound financial instrument. B shares are redeemable in 2 years' time. Pause. Yes, they are redeemable, meaning we have an obligation to pay. Name of the next line. Or say, Leiden has a choice as to the method of redemption of the B shares. So even though they are supposed to redeem in 2 years' time, they have a choice. Assuming that statement was not there, then off the bat it would have been treated as what? A liability. But that statement there makes it not to be a liability. So what is the choice they have? Linen has a choice. It may either redeem the B shares for cash at their nominal value, or it may issue 1 million A shares in settlement. A shares are, so what do you think? Two options. You redeem, so you have an obligation to pay the money, or you may what? Issue shares. What is it? Any financial instrument that has these two things at hand. So one side there is a liability, another side there is what? An equity. So if a share has that kind of opportunity, it's a compound financial instrument. Meaning this is a convertible loan note. Sorry, like a convertible preference shares. So it's a preference share, yes, it's a share, but it's a preference share. And we can redeem it, or we'll give you what? Some shares. So it means that B shares in London will be classified as what? A compound financial instrument. So you can see this. So that's the thing about that. So in the exam hall, please take time to read the questions like the way I am reading it. Because if you take time, you should be able to go through. Can we go? So you see that in these standards, you are not supposed to do any working. So you are just talking. Got it? Just talking. Telling the examiner what you know. C is based on my brother, an accounting standard that my brother brought in place. It's called earnings per share, IAS 33, EBS. So let's see what we got here. Okay, so the profit after tax, so PAT, okay, PAT for Patrick, for the year 2009 is how much? 15 million. At 1st October 2018, now when is 1st October 2008? The beginning of the year. Okay, so the company had in issue how many shares? 39 million equity shares. 36 million. So 1st Oct 2009, shares outstanding 36 million. And 10 million 8% convertible what? Loan note. Now, immediately you hear convertible loan note, what comes to your mind? Immediately you hear convertible loan note, what comes to your mind? And we are dealing with earnings per share. Meaning that we will assume that the conversion is going to what? Take place right now. Does it make sense? That's what we say. Anytime we are dealing with earnings per share, and there is a convertible loan note, we are going to be calculating weighted average number of equity shares. In doing that, we are going to be assuming that even though the shares will be redeemable in whatever years in the future, they are going to be redeemed right now, today. Does it make sense? Okay. The loan note will mature in 2010, okay, and will be redeemed at a par or converted to equity shares on the basis of 25 shares for each $1. So conversion policy. 25 shares for each $100. Okay. If that is the case, we will come back to that in a moment. On 1st January 2009, Bastard made a fully subscribed rights issue of 1 new share for 4 shares outstanding or held. So there is also a right issue. I like the question. Of what? 1 for what?
1 for every 4 shares.
So 1 for 4 of the shares what? Outstanding. So remember, the year start is 1st October 2008, and the right issue was done on 1st January 2009. Okay. at a price of how much? 2.80. What?
1 for 4.
Yeah, 1 for 4. At a price of 2.40. Sorry, 2.80. The market price of the equity shares of Bastard immediately before the right issue was what? 3.8. So current, which is like the cum beef price, was 3.8. You know, anytime there is right issue, they do it below what? The current market value. The earnings per share reported for the year ended 30th September 2008 was how much? So this is part in 2009, and then in 2008, meaning the previous year, it was what? 35 cents. And we are told that the tax for Bastard, I said Bastard, sorry, Bastard is 25% required. Calculate the basic earnings per share figure for Bastard, including comparatives, and the diluted, comparatives not included, that will be disclosed for the year ended blah 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 2009. So what do we do here? He said we should calculate the basic earnings per share. So if we are calculating basic earnings per share, what do we do? Basic earnings per share equals the profit after tax over what? The number of shares outstanding. So profit after tax is 15 million for the year divided by the number of shares. How much? 36 million times 100 cents. What do I have? Times 100. Okay. So this is 41.6 cents. Okay. Madam. No, sir.
36 million. What is it at 1st October 2008? The company had an issue 36 million pesos. So I thought it's related to 2008.
Oh.
And then the profits after tax.
But didn't it occur to you that the year ended in September?
I didn't take that 20% because when I saw the 2008, the company issued 36 million. Yeah.
So that is one thing you have to take into consideration. So that is for earnings per share for when? 2000 and what? 2009. For 2008, it has been given to us as how much? 36 cents. Or how much was it from the question? 35 cents. So this is the earnings per share, basic. Then we come to the diluted earnings per share, which is going to be what? Weight. Still profit after tax over what? Weight. But you've got to be careful what is happening in this question. Why must we be careful? Because number one, there is a convertible shares. And number two, there is what? Right issue. So we got to be careful what is happening here. When was the right issue done? On 1st January
2009.
Okay, so on 1st January 2009, the right issue was done. But then this convertible loan note was there at the start of the year, isn't it? Was there at the start of the year. So let's see the work is. Meaning that, you know, anytime there is convertible shares, our part is going to be adjusted. You remember that? Then our ways, that one there traditionally we need to what? Adjust it. So how do we go about the workings? This is how we go about it. Number one, let's adjust the profit, taking into consideration the convertible loan notes. So part 2009. Give me the parts before. Part for the year was 36 million, right? No, 15 million. Then look at it. The interest on the convertible loan. How much was the interest rate? How much was the interest rate on the loan notes? 8%. So 8% of how much? What was the nominal value of the loan note? 10 million. So 8% of 10 million, what do we have? What? 0.8. Now, if you give me wrong figures, it's your case. Okay.
10 million.
Nhyira.
800.
So we are working in millions. So 0.8. Then you know that we are going to bring the we are going to deal with interest net of tax. So the tax that we will receive from this interest will be what? 25% of what? The 0.8. What do I have? 0.2. So in effect, the benefit you will get if the loan notes are converted today will be 0.6. So we add the 0.6 to the 15 million. That will give us 15.6. So this is now the part we are going to be using when we are dealing with what? The earnings per share. This is something you have to make sure you don't forget. Okay, so let's continue. So please follow the case very well. Anytime there is convertible loan notes and we are calculating diluted earnings per share, we need to adjust the profit after tax. Why? Because we are assuming that the convertible loan notes are converted today. If the convertible loan notes are converted today, then we won't pay this interest again. So we have to add it to our profit. But then, because interest is tax deductible, it means once we are not paying the interest, we won't also what? Enjoy the tax benefit. So we will subtract that, and then the net value is will be added to the original profit, and we'll get a new part. Okay. Having done that, now because the loan note and the shares were outstanding, there will be no problem. But what is the conversion policy? 25 shares for each what? $100 bond. So what will be the extra shares to be converted? Extra shares on conversion. The nominal value is 10 million. So 10 million over 100 times what? 25 shares. Please, when you are punch the whole 10 million and divide it by 100 and multiply it by the 25. What you way by way I went to because way in a million. Way just 100. I hope you are getting it. That's how we get the extra shares. So punch it out for me. Let's see what we got. 2 million. So this is the shares that we are going to get on the extra conversion. Now this will be added to our wins later on when we are dealing with the diluted earnings per share. So that is how we deal with the loan notes. But also embedded in this question is our old boy called right issue. Now when it comes to right issue in earnings per share, it's a dilution. Hence, we need to calculate what we refer to as what? The bonus fraction. Then the bonus fraction will affect the shares that were outstanding before the right issue, but will not affect the shares that were outstanding after the right issue. So what do we do here? This is what we do. To calculate the bonus fraction, what did we say was the bonus fraction? Formula. Elijah has a tail. Cumulative say. The current market price, right? So share price, which is the cum price over what? The theoretical X right price. Yeah. Actually, people are sharp. Crawford being rough. Mark being rough. Okay, so I said this one will be given to us in the question, right? It was given as what? 3.8. You got that? Remember that? 3.8 in the question. So now, how do we get a theoretical right price? We apply the rule here. So we go. So shares, value. Okay. So currently, if you are having 4 shares at a price of 3.8, it will be what? What's it? 15.2. Confirm. Then under the right issue, you will get an additional share at what price? 2.8. Into your 2.8. So in total, what we got? 5 here, 18 here. So we can now calculate our theoretical X right price. So theoretical X right price, which is the same as what? What is another name for the theoretical X right price? The new market value. Are you getting it? Which is in our book, so not on the stock exchange market. 3.6. There you go. So you see that I told you that when they do, the company makes a right issue, the market value falls. So you see that currently it is 3.8, but now the new market value is what? 3.9. So this is what gives us the bonus fraction. So divided by 3.6. Now, when you divide, what do you have? Or what do you get? 1. 1.05. So can we take it to 1.1?